Okay, so you've probably heard the term financial derivatives, right? They pop up in the news a lot. But understanding what they really are, their history, how versatile they can be, well, that often gets buried under layers of jargon. So in this deep dive, we want to cut through all that. Our mission is to unpack this complex topic, make it accessible, interesting, and, genuinely useful for you.
Exactly. And we're using the NISM Series 8 Equity Derivatives document as our main guide here. It gives us a really solid base to explore the what, the why, and the how of derivatives. We'll pull out the key insights, the things that really matter for you, the listener.
Great. So let's start right at the beginning. The core idea. We know a derivative gets its value from something else, right? An underlying asset.
Mhm.
But what's really striking is just how wide-ranging that underlying can be.
Oh, absolutely. It's way beyond just the stocks and bonds most people might think of first. The source really highlights this. The range is huge. You've got metals,
Yeah.
gold, silver, copper, zinc, all those.
Right, industrial stuff.
Yeah, and energy too. Crude oil, natural gas, even electricity. Then there are agricultural commodities. Wheat, sugar, coffee, cotton,
Wow, okay, so physical things.
physical things, and of course the financial assets we expect, shares, bonds, foreign currencies. The key takeaway here isn't just the list, it's what it means. This breadth shows why derivatives are so pervasive. They're tools for managing price risk across almost every part of the economy. That's the power, that adaptability.
That adaptability really does explain why they're everywhere. Now, you might think, okay, complex financial tools, probably a modern invention, maybe something from the last few decades. But here's the surprising part. Derivatives. They're not new. Not at all. Their history goes back way, way further than most people realize.
It's actually fascinating. It shows how long people have been trying to manage future uncertainty. Think about 12th century Europe. You had sellers at trade fairs signing contracts, promising to deliver items later on.
Okay. Early forwards, maybe.
Sort of, yeah. And then in 13th century England, you had Cistercian monasteries selling their wool harvest, sometimes 20 years in advance to merchants overseas. That's really early risk management for their income.
20 years.
Yeah. Of course, it wasn't always smooth sailing. Remember the Dutch tulip mania? 1630s.
Oh, yeah, the classic bubble story.
Exactly. Fortunes made and lost on essentially tulip futures. A very dramatic lesson about the risks. But on the more practical side, jump to late 17th century Japan, they developed a pretty sophisticated futures market for rice in Dojima, near Osaka. This was specifically designed to help rice producers protect themselves from, bad weather or wars messing with prices. Shows that practical protective origin.
So from these kind of ancient agreements and agricultural markets, we see this evolution, but it really accelerated in the modern era, right? Especially in the US with formal exchanges being set up.
That's where things really started to get organized. The big step was systematizing it all. The Chicago Board of Trade, CBOT, started in 1848, initially just facilitating forwards. But then, 1865, that was key. CBOT listed the first actual exchange-traded derivative, what we now call futures contracts. Standardized, traded openly.
Brought it out into the open, standardized it.
Right. And the institution building continued. The Chicago Mercantile Exchange, the CME, came out of an earlier board in 1919. Then the 70s and 80s were just explosive. 1972, CME launched currency futures. 1973, the CBOE started trading listed options, another huge innovation.
Options coming into play.
Yep. And then interest rates. CBOT brought out Treasury bill futures in 75, T-bond futures in 77. Then you got Eurodollar futures from CME in 82, and the very first stock index futures from Kansas City.
Stock index futures, so people could trade the whole market direction.
Exactly, broad market exposure. And CBOE followed up with options on indices like the S&P 500 in 83. It was just one innovation after another.
That's quite a rapid development phase. What was really driving this huge growth over, say, the last 50 years? It wasn't just the new products, presumably.
No, it was driven by real market needs. Think about it. Underlying asset prices, currencies, interest rates, commodities, they just became much more volatile globally.
More risk to manage.
Precisely. And financial markets were becoming much more interconnected worldwide. Plus, technology dramatically cut transaction costs.
Made it cheaper and easier to trade.
Right. And alongside that, there was a growing understanding, a sophistication among market players about how to use these tools for risk management. Add in constant innovation, new ways to apply them. It just created this massive growth spurt.
Okay, so that's the global picture. Bringing it to India, India also went through its own process to introduce derivatives, right? It seems like it was quite a structured approach.
Very much so. India's approach was notably methodical, really focusing on getting the regulations right first. SEBI, the regulator, kicked things off in 1996. They set up the Dr. L.C. Gupta Committee specifically to build the framework.
Laying the groundwork.
Exactly. A key step was in '98 when the committee recommended derivatives should be officially classified as securities. That put them under existing solid regulations. Then another group, led by Professor J.R. Varma, focused on the nuts and bolts risk containment, margining systems, who could be a member. Really practical stuff.
Getting the safety mechanisms in place.
Right. Then in '99, the law, the Securities Contract Regulation Act, was actually amended to formally include derivatives as securities. And finally, in March 2000, a long-standing ban on forward trading in securities was lifted. Paved the way.
Okay, so the rules were set. When did trading actually start, and what did those first products look like in India?
Once that foundation was solid, things moved pretty quickly. June 2000 was the kickoff for exchange-traded derivatives. SEBI gave the green light to the BSE and NSE to start with equity derivatives, specifically index futures, Nifty futures, Sensex futures.
Starting with the broad market indices.
Yeah, makes sense. Then diversification happened fast. June 2001, index options arrived. July 2001, options on individual stocks. Then November 2001, futures on individual stocks. And more recently, Feb 2013, the Metropolitan Stock Exchange, MSCI, also joined in, offering derivatives products, so gradual expansion.
Okay, so we've got this history, this growth, these regulated markets. Now, let's get into the actual products. You mentioned four main types. Can we break those down?
Sure. The source lays them out clearly. First
Okay.
up, forwards. Think of this as a totally custom agreement, just between two people or two companies. They agree to buy or sell something, say a specific amount of currency, at a price they decide now, but for a date in the future.
Okay, very direct, one-to-one.
Exactly. It's traded over the counter or OTC, not on an exchange. And the crucial thing is, both sides must honor the deal. It's a firm obligation.
Got it. Obligation, what's next?
Next are futures. These are very similar to forwards in concept, agreeing on a price now for future delivery, but with key differences. Futures are traded on organized exchanges, and they are standardized.
Standardized, meaning?
Meaning the contract terms are fixed by the exchange. The amount of the asset, like the lot size, the quality, the delivery dates, everything's preset.
Ah, okay, so not custom, like forwards.
Right. This standardization makes them easy to trade back and forth between many participants on the exchange. Think of them as exchange-traded forwards, basically.
Okay. Forwards are custom OTC. Futures are standardized on exchange. What's the third type?
Third, we have options. Now, options are different. They give the buyer the right, but critically not the obligation, to do something.
The right, but not the obligation. Explain that.
Okay, imagine you think a stock price might go up. You can buy a call option. This gives you the right to buy that stock at a specific price, the strike price, before a certain date, the expire date. You pay a price for this right, called the premium.
Like an upfront fee.
Exactly. Now, if the stock price goes way up, above your strike price, you can exercise your option, buy the stock at the lower agreed price, and potentially profit.
But if the stock price doesn't go up or goes down?
Then you just let the option expire. You're not obligated to buy the stock. You only lose the premium you paid initially.
Ah, okay. So you cap your potential loss at the premium paid.
Precisely. And the seller, or writer, of the option, they receive the premium up front, but they do have the obligation to sell you the stock if you decide to exercise your right. There are put options, too, which give the right to sell.
So options offer flexibility, but at a cost, the premium. Makes sense. And the last one, swaps.
Right. Swaps. These are agreements where two parties agree to exchange cash flows in the future based on some pre-agreed formula. Think of it maybe like a series of forward contracts bundled together.
Exchanging cash flows. What kind?
Most commonly, it involves interest rates. For example, one party might have a loan with a variable interest rate, but they want the certainty of a fixed rate. They could enter into an interest rate swap with another party, maybe a bank, where they agree to pay the bank a fixed rate, and the bank agrees to pay them the variable rate they owe on their loan.
So they swap their variable payment for a fixed one.
Exactly. It helps them manage that interest rate risk. Swaps are also very common for currency exchange rates and sometimes commodity prices too. Powerful risk management tool, usually between institutions.
Okay, that clarifies the four main types. Now, who's actually using these instruments? You mentioned risk management, but there are others involved too, right? Like different players on a stage.
That's a good analogy. The source identifies three main groups of participants, and they have very different goals. First, you have the hedgers. These are the ones primarily focused on reducing risk they already face.
Like the company swapping interest rates.
Precisely. Or a farmer using futures to lock in a price for their crop, or an airline hedging fuel costs. They have an existing exposure they want to protect against. Their risk appetite for that specific risk is low.
Okay, makes sense. Protecting against downside. Who else?
Then you have the speculators, or you could just call them traders. Their main aim is different. They're trying to profit from predicting future price movements. They take positions based on whether they think an asset's price will go up or down.
They're taking on risk deliberately.
Yes, they generally have a high risk appetite. Derivatives appeal to them because of leverage. You can control a large value asset with a relatively small amount of capital. Plus, transaction costs are often lower and execution is fast.
So hedgers reduce risk, speculators seek profit from taking on risk. Is there a third group?
Yes, the arbitrageurs. These guys are looking for basically free money, though it's rarely easy. They try to exploit tiny temporary price differences for the exact same asset in two different markets.
Like if a stock is trading for slightly different prices on two exchanges simultaneously.
Exactly that. Or maybe a future contract price is slightly out of line with the underlying stock price plus cost to carry. They'd buy in the cheaper market and sell in the more expensive one at the exact same time. Their actions actually help keep prices aligned across markets, making them more efficient. But these opportunities usually disappear almost instantly because arbitrageurs act so quickly.
Interesting. Hedgers, speculators, arbitrageurs, different motivations, all using the same tools. Now, where does all this trading happen? You mentioned exchanges and OTC.
Right. There are two main arenas, exchange-traded derivatives and over-the-counter OTC derivatives.
We touched on this with futures versus forward.
Exactly. Exchange-traded ones, like futures and most options you hear about, trade on organized exchanges. Think NSE, BSE, CME, CBOE. The contracts are standardized, like we discussed. Prices are set transparently through an open auction system. And crucially, there's a central clearing corporation.
The clearing corporation. What's its role again?
It acts as the middleman for every trade. It becomes the buyer to every seller and the seller to every buyer. This means it guarantees the performance of the contract. If one side defaults, the clearinghouse steps in. Massively reduces counterparty risk.
Okay, that sounds pretty secure. What about the other type? OTC.
Over-the-counter, OTC derivatives are different. These are negotiated directly between two parties. Think big banks, corporations, hedge funds. It's not a physical place, more a network of dealers connected electronically or by phone.
So more like the forward contract example.
Yes. The key features. Contracts can be completely customized, tailor-made to specific needs. But this comes with trade-offs. It's generally less regulated because it's happening privately between supposedly sophisticated players. Managing the risk that the other party might default, counterparty risk, is up to the individual firms.
No central guarantor like the clearinghouse?
Right. And there aren't usually formal centralized limits on position sizes or leverage like on exchanges. And the deals are private, less public disclosure. More flexibility, but potentially more hidden risks.
That's a really important distinction. The standardized, cleared world of exchanges versus the customized, less transparent OTC market.
Okay, pulling it all together now, why are derivatives actually significant? What role do they play in the bigger financial picture? Well, beyond just being trading instruments, they perform some really vital economic functions. The source highlights three key ones. First, price discovery. Derivative prices reflect expectations about the future, and they react very quickly to new information. This helps the underlying markets like stocks or commodities find their true value more efficiently.
They act like signals for the market.
Kind of, yes. Second, risk transfer. This is huge. They allow risk to be shifted from those who don't want it, the hedgers, to those who are willing to take it on the speculators. This allocation of risk is crucial for economic activity.
It allows businesses to focus on their core operations without being crippled by price swings.
Exactly. And third, perhaps counterintuitively to some, they can contribute to market stability.
Stability. You often hear about derivatives causing instability.
That's the risk side, which we'll get to. But the argument here is that by providing a regulated, transparent place for speculation, the exchanges, they draw that activity away from potentially dodgier, unregulated corners.
Yeah.
The risk management tools on exchanges margining, clearing houses, provide a more stable environment than purely unorganized speculation.
Okay, I see the logic. Price discovery, risk transfer, and potentially market stability through organization. But we have to talk about the risks, right? These are powerful tools, leveraged.
Yeah.
They can cut both ways.
Absolutely crucial. The source is very direct about this. Leverage magnifies everything gains and losses. Anyone involved needs to understand the specific risks. It lists several key ones. Counterparty risk, we mentioned this, especially relevant in OTC markets. The risk your counterparty fails to deliver on their side of the deal.
Right.
Price risk, the most obvious one. The market moves against your position and you lose money. Because of leverage, those losses can exceed your initial investment.
Exceed your initial investment.
Yeah.
That's serious.
Very.
Mm-hmm.
Then there's liquidity risk. This is the risk you can't get out of your position easily when you want to, maybe because there aren't enough buyers and sellers at that moment. You might be forced to take a worse price or not be able to exit at all.
Stuck in a losing position?
Potentially. Also, legal or regulatory risk. Maybe a contract isn't enforceable or rules change unexpectedly. And operational risk, things like errors in execution, fraud, system failures, bad record keeping.
That's quite a list of potential pitfalls.
It is, and it leads to a very strong warning in the source material.
Which is?
Basically, that derivatives might simply not be appropriate for everyone, particularly someone with limited financial resources or limited trading experience, or just a low tolerance for risk. The potential losses can be substantial.
So know yourself, know your limits, and understand what you're getting into.
Absolutely. Due diligence is paramount.
Yeah.
And the source specifically flags something important here. The Model Risk Disclosure Document. It's a document that brokers are required to provide. It contains vital information about the risks involved in trading equities, and especially the futures and options segments. The advice is crystal clear.
Yeah.
Anyone thinking about trading derivatives must read this document carefully beforehand. It lays out the dangers. Don't just tick the box.
Read the fine print, basically. Crucial advice. Okay, we've journeyed quite a long way here from, 12th century trade fairs and Japanese rice markets, all the way to modern complex instruments traded globally on exchanges and OTC, the different players involved, the vital functions they perform, and crucially, the significant risks.
It's quite an evolution, and it leads to a final thought, perhaps. Given how these tools have evolved from simple promises of future delivery into these incredibly complex instruments, and knowing the different roles people play, hedgers managing risk, speculators seeking profit, arbitrageurs ensuring efficiency, what responsibility do we all have, whether we're active participants or just observers of the market? What's our responsibility in understanding these powerful tools and navigating them wisely to ensure, future financial stability while still allowing for innovation?